Okay, so what are you saying, people, and welcome back to your favorite YouTube channel. So today, guys, we'll be talking about a secret candlestick pattern. Now, this pattern works really well on the weekly time frame, and it all kind of stems from liquidity and fake outs. And I do have a couple diagrams on my screen just so on the same page on liquidity and on fake outs. I do talk a lot about it on my streams and my videos, so if you do watch them regularly, you should be aware. But if not, we'll go through some examples shortly, and then we'll go take a look at the pattern. But yeah, today we'll be talking mainly about fake outs and liquidity. It's a pattern that I do look for a lot in the weekly time frame. It is universal, happens across all time frames, but for me personally, especially for my style, it works really well on the weekly. But first, let's go over some basics. So liquidity and fake outs is essentially price faking to go one way to go the other. Grab liquidity, people stop losses, fake people out in the wrong direction, just to go the other way, which if you've been into the market some time, you probably will be aware of these type of patterns happening quite a lot. So as you can see on the left, we've got some bullish structure heading up, bearish structure heading down, higher highs and higher lows, lower lows and lower highs. Very simple. However, sometimes the market will take out a low or take out a high to grab liquidity to move in the opposite direction, and we call this a fake out. Now, as you can see here, a bunch of higher highs and higher lows. Then we get this big move to the downside. Market clears out this low and then suddenly continues higher. Normally, when we expect market to take out the low, we actually expect a reversal. However, in this example, price used that low to actually continue higher. And same with this as well. You can see the lower lows and lower highs here on the right. Price takes out that high, fakes out, people be buying on top of that, stop losses above that as well, and that actually funds the move to go lower. Now, this concept is very powerful when you combine it with candlesticks. And I'll show you what I'm talking about in a second, but this is essentially what we're looking at, price faking one way to go the other. Now, the key question is, how do you determine if it's a fake out or if price is actually breaking structure? Because like I always say, if you want to wait for a reversal, wait for the break of structure. Theoretically, we are breaking through structure here. We're breaking through the prior low. So how do you know it's actually a break of structure or a fake out? And truth be told, you don't actually know 100%, but you can make assumptions that it's doing one or the other with good probability and a high win rate based on a specific pattern on the weekly time frame using candlesticks, which we'll go into in a second. So that's all kind of looking for from a fake out liquidity perspective, price faking one way to go the other, and how this helps us as traders. If we know the market's faked out in one direction, we know there's a high probability the market's going to go in the other direction. So if we know this is a fake out, or at least assume it's a fake out, we're looking for buying opportunities after this, and vice versa. After this, we're looking for sell opportunities, and this will give us good confidence for our trades. And I actually used this on a recent trade on pound NZD. You can see here, this is consolidation, same thing. Let me actually go through it really quickly. So here we've got trending examples, the bullish trend and the bearish trend. And this is a consolidation, so you've got the market moving sideways. Sometimes the market will push up, fake people out to actually break in the opposite direction. So this is the fake out, grabbing liquidity above these highs here. These are equal highs and equal lows, the market moving sideways, fade to the upside and then continue down. So it's the same pattern, but just in consolidation. And this is what happened on pound NZD for the trade I had last week, but I only closed it this week. Was it last week? Maybe the week before. So yeah, pound NZD was consolidating. You can see all of these wicks here. The market's very messy in this area, and you can see here we had a huge push to the downside. Now the key thing about this pattern is looking at candle closures and wicks. Wicks typically mean fake moves. The market tried to move higher but it got rejected, so it pulled price back down. If I get some makeshift candlesticks here, hopefully that will make a little bit more sense to you guys. So let me just, there we go, try and center that, or just make that wider, just so you guys can understand what I mean by wicks and candlestick bodies. So say this is our candlestick here, and say we've got a big wick to the upside. The market was quite bullish, tried to push up, failed to do so and pulled all the way back down. This is a sign of inability to go higher. If, however, we get a candlestick that looks like this, bear with me, and I bring this here, and we bring this up here. Ooh. It's confused, can't see which one's which. And then we bring this all the way up there, and we bring this here. You can see this candle on the right has a lot more momentum and has a bit more conviction. This, if you see the wick is very, very small, there's a sign that the market actually wants to go that way and is having a good time doing so. This is a sign that we want to go up, but we're failing to do so. So when we see wicks like this, it's a sign of inability, a sign of rejection, that the market's trying to go lower, but failing to do so. And you can see here with this wick, it takes out all of these lows here. So all stop losses underneath this bit would have been taken out with this wick. So we can tell that this push to the downside, that wick, is a sign that the market is faking to go lower in order to go higher. That's the theory behind fake out. We fake one way to go the other, fake that way to go that way, so on and so on. So we're looking at the market faking to the downside to go to the upside. So after that weekly candle had closed up here, it's a big fake out to the downside, and we can take that information to the low time frames because now expecting the market to break higher. As you can see, that's exactly what it did, and actually how I got some confluence for my pound NZD trade. I did a full breakdown on that video, link in the description. And we also saw it earlier here as well. As you can see, this was a big fake up to the upside. Look how many highs price is taken out there on the left. So many highs here on the left. Big wick to the upside, pull back by the weekly candle has closed. So we've just got a big wick to the upside, and what happened? We saw a move to the downside. Obviously it didn't sustain because then it faked lower to actually go higher. But if we go to the daily chart, you can see this was our fake out, and you got some really nice selling opportunities, you know, in this area here to go to the downside, just taking information from the weekly, and that gives you your buy straight off the bat. And if we go to the USD CAD, you've seen this happen quite a lot of times, even on a miniature scale as well. You can see here, if we zoom in, look at this candle here, big shooting star, you know, taking out this high there on the left, big wick to the upside, really nice dump to the downside, and you can see that follow through there for the next few weeks. Even this wick here, nice wick to the upside, taking out that high. Again, you can see the next week was bearish. Even here as well, big wick to the upside, taking out that high there on the left. You can see the next week after, let me just use this because it's just very choppy. You can see the next following week was very bearish after that as well. So this pattern happens a lot. You can see here, big wick there, taking out this low here on the left, or a couple of those lows there. After that, bullish candles closed, follow through to the upside. You can see here as well, here's another example, big wick to the upside, taking out these highs here, big follow through to the downside. You can see here as well, taking out that low there, big wick, big follow through to the upside there as well. So it happens many times. Even this one, big wick to the downside, taking out that low. Next, we saw a push to the upside, and so on and so forth. It happens quite a lot of the times. If you zoom out into the weekly time frame, obviously you go lower time frames, a little bit less. But you can see here, just about there as well, big wick to the upside, just about taking out those highs, and then giving us a really nice sell-off to the downside. Even here as well, you can see taking out some highs there, lower highs, big push to the downside. So the key thing you want to be seeing is price wicking in one way. Doesn't matter if it's up or down, you want it to be in line with structure. So it's important to use this candlestick pattern in the line of structure, in the direction of structure. You don't want to use this against it. So like, for example, this big wick here, I wouldn't anticipate the market going higher because we are seeing bearish structure here. The market is falling, so this is invalid. This is good because we're in line with the market. This is bad. Do not anticipate that for the market to go higher. It might do, yes, but that's just a lower probability trade, and we obviously want to be focusing on the higher probability pattern. So this wick good, this wick no. And yeah, you can see the market does it quite often in these bearish trends. I mean, not too many examples here. I'm trying to scan across. Yeah, not too many examples up there. Let me go. Let me see if I can find one more of these patterns. USD CAD is a little bit choppy pair, to be honest. Okay, so we had one here. Really nice push to the downside, and the market just about wicked it, as you can see, taking out that low. Closed bullish, and then we've got the continuation to the upside as well. So again, even here as well, nice wick there, shooting star pattern, taking out that high, follow through to the downside. So normally with this pattern, you probably only want to anticipate at least one bearish or bullish candle in the same direction. Sometimes if you've got a stronger trend, you know, with you, then maybe you can see a big continuation like this. But just anticipate 1 week or 1 day or one 4H candle, depends what time frame you're working on. Like I said, it works a lot better on the weekly time frame, I found anyway. So yeah, go try it out for yourself, guys. It is a nice pattern to help with your bias. It's not something that you trade alone. Again, like we've just gone over, we haven't gone through any specific trades. We've just gone through direction, and that's what we're using this for. Using the weekly time frame, seeing which way liquidity is being grabbed. If it's the downside, cool. We anticipate the market going upside and vice versa. Important though, make sure it is in the direction of the trend, direction of momentum and structure. Don't go against it. It has a much less win rate or probability of playing out to do that. So yeah, guys, like I said, go and test it out for yourself. Go try it out. Again, it is universal, happens on all time frames. But for me, the soft spot is the weekly time frame. So go and try that for yourself as well. If you have enjoyed the video, guys, and found it useful, please be sure to drop a like and subscribe to the YouTube channel. If you haven't done already, hit the bell as well. But yeah, guys, thank you so much for watching the video. Have a great weekend, and I'll catch you all next week.